All right. So we have Michael, Tracy, Kelsey, Mercedes. Can you guys let us know where you are located right now? Where are you right now? What city? So we can know how far we're reaching people. VA 757, Virginia Beach, awesome.
McLean.
Just go ahead and put it in the chat for us so we can know our audience. Welcome everyone. We're so excited. We're working so hard to help our community understand innovation and entrepreneurship and everything that it takes to be ready. Dean Carrington, who's our pioneer and our head, has a motto for the School of Business, is what I call it. It's called First Day Ready. In that same sense, we want you to be investor ready. So we are reaching people around Virginia and outside Virginia, Newport News, Virginia Beach. Okay, welcome everyone. We have Oceanfront, Maryland, Newport News, okay. Hudson. Aldi? I have not heard of that yet, but welcome, Basil. Awesome. So good to see everyone. Cool. So just quickly, let us know what you want to learn today. What are you looking to get out of today's meeting? We're so grateful to have Jim Hunt to join us to get a new perspective of what the venture capitalist world looks like. So what do you want to learn today? Let Mr. Hunt know. You can put it in the chat.
Can you see me okay, Koshia?
I'm searching for you. Yes, I can see you.
Okay, I can't see myself. Okay.
We'll get started in just a minute.
No problem, no problem.
Hello, Glenn.
Hello, Jim. How you doing?
I'm doing fine, thanks.
Good.
Okay. What is he looking for when he invests his money into business? Yeah, that's great. I really also like the title today, A Peek into the Venture Capitalist World. Dean, can I have you move away from the window so we can see you? Yeah.
Here? See me better?
Away from the window. To the, yeah. Right there.
Okay, I can let the blinds down more.
Okay, that's great. Yeah.
Should I let the blinds down more?
Yeah, if you can, that would be great.
Yeah.
Okay. So avenues, methods to pursue capital for small business outside of loans. Yes, Tracy, that's great. Is it realistic to pursue venture capital for a small business? Okay. Kind of similar to also knowing what he's looking for when he's investing into a business. Early stage, small business. Awesome, Tracy. Okay, great. Again, welcome everyone. We're so excited to have you guys here. We're excited to have Dean Carrington from the School of Business of Norfolk State and Jim Hunt as a venture capitalist. We also have Jim Franklin on board. So we're excited to have everyone here. I want to say thank you for my team, Norfolk State Innovation Center, for pulling this together and everything that you guys do behind the scene. Kelsey, Tiffany, Tiffany's going to be helping us wrap up the questions that you guys have. So again, what I'm going to do is introduce Dean Carrington. Dean Carrington is the Dean of the School of Business. And like I mentioned earlier, at the School of Business, we want Norfolk State to be a champion in Virginia when it comes to education and nurturing our college and our community. And so we have a motto called First Day Ready. So in that same sense, in the Innovation Center, we want everyone that come into our domain and into our territory to be first day ready when you approach an investor. So we have Jim Hunt here, but I'm going to allow Dean Carrington to talk about his relationship with Jim Hunt and why he really wanted us to put this event on for you today. So sit back and enjoy. Go ahead, Dean.
Thanks, Akosia. Hi, everyone. Glenn Carrington, Dean of Business School at Norfolk State, and so proud to be here today to talk to you. I have the true honor of introducing a person that's been so many things to me. A great neighbor, a great friend, a great board member on the School of Business Board, Advisory Board. He's even helped me raise my kids. I mean, you can't get any better. And I've asked him today to come here and talk about something that's also very dear and near to his heart, being an entrepreneur and venture capitalist. I wanted him to share with us his my extended family, the Innovation Center at Norfolk State, and people in the region, what it takes, what a venture capitalist looking for in terms of when they will loan you money or when they will not. What are the turnoffs that will put you in a position not to get the money? What are the things not to do? So what are the things to do to help your cause, to help your situation? And what are the things not to do? Jim has been a venture capitalist for a number of years. He also teaches at Notre Dame as well as Georgetown in entrepreneurship. But most of all, he has this experience, real life experience that we need to pass on to our members or associates with the Innovation Center. One of the things I want to like to improve upon, underprivileged people get a very limited number of venture capital dollars in America. I think African Americans get 0.2%. And we got to find a way to improve that. And through conversations with people like Jim and others, we hope to figure a pathway to get more of those dollars so we can move our businesses into what I call profit land and a good place to be. So with that introduction, I'll turn it over to Jim. And Jim, we thank you. And we look forward to your conversation.
Dean. Appreciate it. In Dean Carrington taking the position as the dean, I lost a great neighbor is the problem. He was he and his family were wonderful to have around. And my 4 daughters and his 2 sons were great friends through a lot of formative years. I want to give you a little bit of background because I'm what I'd like to call an accidental venture capitalist. A lot of VCs come up through the ranks. They're associates in firms or interns in firms. In fact, I've had a number that have gone on to be VCs. In my case, I kind of backed into it. So I started out as a government guy. I was a scientist by training, and I did that for 8 years. And then I left and kind of in seeing things that I didn't think worked very well in the government was part of my impetus in starting my first company. And so I did that and grew it through the 80s. And my first kind of introduction to venture capital is I had venture capitalists invest in my company. We brought that money in 86, and then we went another 5 years. And if you are going to take venture money, you should always assume that you're going to exit because that's how they make their money. They try to build your company or assist you in building the company value, and then their whole goal is to exit the company, obviously, for more money than they put in originally. And I'll talk about that as we go. But we were lucky. We merged our company in 1991 and then went public in 92. And it was from the exit of that company that I was able to scrape some money together and then begin doing my own angel investing. Went on to run two more companies, or I ran a practice at Price Waterhouse and then was made CEO of what was called Ernst & Young Technologies and did that. But all through the time of running those latter two was continuing to do angel investing, not venture capital investing. And there is a difference that I'll also talk about. But that gave me, I always say it's sort of my drug of choice is investing in these small startups and trying to help the founders understand some of the pitfalls that I witnessed when I started my company. And then in 2006, we sold Ernst & Young, or 2004, and I had to do 2 years with the acquiring company. And then subsequently after that, almost all my time is taught either teaching or investing in startups. So with that, I'll kind of walk through this, and you can certainly, if Koswa or anybody can kind of monitor it, if chats come in, please interject, but we're also going to have time at the end to spend time on Q&A. So, I always start out with sort of the bad news, and it gets better from here. So please don't take this as total gospel, but there was a survey done some years ago that involved looking at startups in Silicon Valley, obviously a hotbed of venture capital and startups. And what the findings concluded is that of 6,000 companies they surveyed, where the founders took $1 million or more of capital, of venture capital or angel capital, only about 20% of those founders saw a return. And that's because there's tons of pitfalls in structuring your deals. And there's tons of pitfalls in just thinking you can go out and raise a ton of money and necessarily have a good outcome. So you have to learn a ton about kind of what are the nuances to how the terms are written by the venture or angel group. And you have to understand that at the end of the day, you've got to make those companies work, or none of us really do well. You as founders or we as investors. And then another very, very interesting quote in here is that Paul Graham, who one might argue is maybe the world's expert on startups, he runs an incubator called Y Combinator, extremely well thought of, very, very mature group. Every year he looks at hundreds and hundreds of companies to bring into his incubator, Y Combinator, and he invests, used to be invested $75,000 in 30 companies a year that he brought in to incubate or help. Now I think he invests more, but it started out as that. And what he found is that he's returned $10 billion from those investments of 30 companies, say 100K or 75,000 each. But what's very, very interesting is that 75% of his returns are from only 2 investments. So imagine he's been investing in 30 companies a year for many, many years. I think he started in the late 90s. So let's say 20 years, that the majority of his returns still came from only 2 companies, one Dropbox and the other Airbnb. And by the way, when he picked those companies, he always says that neither of those 2 he thought were in the top third of the cohort for that year. In other words, of the 30 companies, he didn't think either one, Airbnb or Dropbox, were necessarily going to be the home runs they wound up being. And this goes to something that the venture capitalists have to learn to live by, which is called the venture capital power law. And what that says basically is I have to have in my fund, our fund, which I'll talk about later, is 11 investments. In our case, we're all tech. That's pretty much all we do. But in those investments, I have to have one or two that do extraordinarily well to return the capital I need to return to the people that have invested in our fund. So, if any of you can figure out how to make me better at finding new companies to invest in, I'm all ears. It's an odyssey of trying to learn and use intuition and experience to do that, but it is not a pure science. There's a fair amount of art, and I'll talk about it. And to one of the questions that came up earlier, I'll talk about what I look for as I'm considering investing. So many of you may not have ever heard of the Inc. 500, but there's a magazine called Inc., and every year they come out with a survey of what they think of the fastest growing private companies in the country, and there's qualifiers to be in there. You can't grow from $1 a year to $10 a year. You've got to have more substance or bigger. But when I've looked at that survey, which I do every year, they do a remarkable job of combing the U.S. for startups that are progressing well. And what's very, very interesting, and I always tell my founders this, is of the 500 fastest growing companies in the country every year, only about 33% bring in outside money other than family and friends, which is really pretty interesting. And by the way, that if the founder can figure out how to make significant progress, revenue ramp, et cetera, and doesn't have to bring in outside investors, that's absolutely what you should consider doing. It's harder, in some industries and some companies and others, but on the other hand, the minute you start bringing in capital, the capital has its requirements, and it can be bad. So, interesting statistic, of all the companies I've invested in, the ones that have done the best are companies where I was the only and last investment in. We didn't have follow-ons with bigger angel groups or whatever, and I'll talk about that as we go as well. So what I always tell, an entrepreneur or founder who wants to bring in venture capital money, you have to be aware that we come with our baggage, right? And part of that is we are going to try to direction you on how best to grow your company. You have to be prepared to sell in 3 to 5 years, because that is the way we investors get our money out. And there are some deviations to that, and I'll talk about it. But in general, if you're a venture capital fund, that's what you're aspiring to do, is sell the company in 5 to 7 years. And then, I need to, you as founders need to be able to show the venture capitalists that you've invested significantly. Now, you may not have funds to do that with, but that then involves your time and your effort and your sweat and your tears at getting the company started. And they have to see that desire and that motivation with you, because it'll be a hard odyssey, and they're not interested if they think that you'll just sort of give up the minute anything gets tough. And then the other problem, and this is a problem for startups in general, is the VCs, because we see so many deals, so I average 1.4 deals a day that come across my desk, trying to discern if customers will really buy your product is the biggest issue that we're trying to focus on. Lots of entrepreneurs are bright-eyed and bushy-tailed, and they perceive that people will buy their product, but we investors like to see the best truth we can get from that. You have 2 pilots, you have 5 customers, you have 20 customers. What did they pay? Were they willing to stay and not abandon you if they felt the product didn't give them whatever they were after? So traction winds up being a really important role. The other thing to understand is there's all sorts of ilks of investors in this business. So for example, if you look at this curve, which I apologize, it's a little contorted, but what you'll see is that where you really need money, usually to get the company started, is something we call the valley of death. It's not a very flattering term, but basically that's where you're really struggling to try to figure out if you can get customers to buy your product. And that's where frequently you use money, somebody else's money. I always say when I invest in a company, it's generally for them to really get a more widespread customer acceptance out there. And that's why we like to see a company that already has at least some traction with customers buying the product. And then what you have to be aware of is all of we VCs, all of us investors have niches, right? So we have our niche. If you study our fund website, Lavrock, you can see that niche. But if you go to see, if you come to see me, for example, and I had this discussion the other day with a prospect, is they wanted to raise $10 million. Well, we don't do $10 million investments. So they were sort of wasting their time and mine. That's just doesn't fit our profile at all. So sometimes you'll find a venture capital firm that only does enterprise software. In fact, there's many that only do enterprise software. So if you come to them with a consumer play, a direct-to-consumer play, it's not going to resonate. So I would encourage anybody who's going to see an investor about potentially pitching their company to spend time really studying, what does this venture capitalist invest in? And if you come to see me with, requesting money or funding, and you're outside of my sweet spot, I'm probably not going to be interested. And so if you get that meeting with a venture capitalist, go in and ask for advice. And there's sort of an old rule that when companies ask for advice, they're really asking for money. And one's asking for money may just be asking for advice. But VCs of all ilk can help you kind of traject your company and give you direction, but they may well not be investing. And we do see a ton of deals, so it's hard to get our attention. So this is just another graph that sort of says, how do you begin to try to build yourself toward being profiled properly to be able to talk to a venture capitalist or an investor. And I'll talk a little bit more about this in a bit, but there's different stratas of investment. And, as an aside, when I started my first company, I had no idea what I was doing. No idea. I knew technically what I wanted the product to do, but I knew nothing about business. And so it was a sort of learning by fire. But our first investors, and this is very, very typical, were family and friends. There were people that I had some sort of association with. Some were not a close association. Others were actually family members. And I always say, you can bring in family member money, your uncle or aunt or, somebody or neighbor. But you certainly don't want to, if you can avoid it, lose their money, because then you won't get invited to, Thanksgiving Day. Somebody have a question there or no? So I'll talk about kind of the hierarchy of how you begin. But generally speaking, when you raise your first money, in many cases, it's people that don't necessarily understand your business plan. They're family and friends. They do it because they want to see you succeed, but they know you. And they become comfortable that you won't give up, that you'll really work hard to make your company successful. So many times it starts with people that know you. I have a fabulous story about that, where I had 4 guys invest in me early on. And to be honest with you, they had no idea what our company did, but they kind of shook my hand and said, "You're not going to lose my money, are you?" And it gave me a huge guilt trip. So this happens a lot. This is just another graph that it relates to where angels invest and other people invest, and how you get your money for your startup. The question was raised, and I'll talk about this as well. There are now a lot of different funding bodies that give you what we in the business call non-dilutive capital, so grants, etc. This is particularly true with the military departments right now. So there's programs with the Air Force, the Army, the Navy, and DOD in general that are very aggressive at funding certain technologies and other things. And it's great money if you can do it. It's painful because it's bureaucratic to get, but they don't take any equity. They just are giving you a grant to produce or advance your product for one of their mission sets. And this becomes a very good way to raise money. If it's not something that the military could use, and believe it or not, their requirements are very diverse. It's not just military weapons or some kind of exotic cyber product. They also buy a lot in the medical space. There's a company actually down the street from you guys that I'm an investor in called Embody that has raised a fair amount of NIH money and also military money because they're working on a replacement for a collagen-based replacement for ligaments and tendons. So they've done very, very well with money that doesn't cost them equity in their company. And that's something you should study because it can be a real windfall if you can figure out how your product might fit some of those niches. So I talked a little about family and friends. This is thought to be an enormous source of capital. It's very hard to track because it might be your uncle or your cousin, or it might be your college roommate, or it might be your college roommate's father. So it's very tough to track, but there's been some pretty good surveys recently that suggest this may amount to as much as $50 billion a year being dumped into very early stage companies. And the advantage of family and friends is they frequently will invest very early. They're not looking to put their money in a public stock or something. They're doing it because they want to see you succeed, and it works pretty well. So that's one big source. The next source, kind of one level up, so imagine you've raised a little bit of money from family and friends, are active angels. And again, this is not a perfect science because it's hard to track them all, but there are basically 300,000 active angels in the US. What you will find is that they invest close to home. So for folks, in your part of Virginia or environs, it's usually typical to try to find somebody close to home. The average angels invest within 2 hours drive time of wherever they find the company. They are what is called pre-money valuation. So that is the number you think your company is worth when you go in to see the venture capitalist or investor, because they have to have a basis to understand how much stock they're going to buy. So I won't get into the math here. It's a whole course, but basically, imagine you said my company's worth $3 million and you raise $1 million from investors. Then we say the post-money valuation is your 3 million plus my 1 million. So it's 4 million. And that would assume that then for my $1 million, I own 25% of your company. And so pre-money and post-money valuations are things you should think about. It's also the toughest negotiation with a founder because you founders think you're worth probably more than most investors do. But, we work through it. Naturally, 61% of the deals are in areas of very, very high flying growth. So that's what, angels and others are looking for. And they're investing in roughly 2 to 3% of the deals they see. So it's, a very selective funnel of trying to get their attention. And individually, they may invest 10,000 to 100,000, but they're doing it collectively, frequently in groups. And so collectively, I have an angel group that I've been involved with for over 10 years called Blue Venture Investors. You can Google them as well, but by the way, it's blue with no E. But we invest probably an average of $300,000, but it's 25 angels sitting around the table that all opt in on deals. So some deals, the angels say, I don't think I want to invest in this, and other deals, we gel together maybe 10 to 12 of us and put the money in. But to give you an idea, we see a ton of deals, and I think we've done something like 45 in the past 10 years, so for a year or so. So what is this silly stuff called venture capital? Well, it's groups, venture capital funds, that are willing to take a position in companies that typically are not making money. They're not cash flow break even. Now, you always read about the great ones, which can be Uber or Lyft or what they call a unicorn, which is a company that achieves a value in the market of $1 billion, many of which frequently have no revenue. I always say I hate unicorns because I don't have one of my own. But in any event, it is, it's a very high profile, kind of avant-garde area of the business, the venture capital scene. But for every one that we have that's successful, like I commented on with Y Combinator, we have a lot that don't work. And I'll again give you what we look for to try to mitigate that. But I started out as an angel, spending my own money on these deals. And then I moved to being a syndicated angel, where I worked with angel groups. And then eventually I became a venture capitalist in the last, say, 4 years. And that's different because now I'm investing other people's money on their behalf. And I'll talk about how that works. But one of my esteemed mentors years ago is a man named John May. Many think is kind of one of the fathers of angel investing. And as he says, he wants, this is what you're asking an angel to do in many cases, which take cash money, it's after tax, so I've already paid the tax on it, take a minority position in your company, and I have no dividends, no interest, probably no cash flow, and that money's going to sit in that investment for, as long as 9 years, sometimes longer, and hopefully earn a return over and above my investment at the point that I exit. And the only real thing I have is the rule of law and the trust in the entrepreneur. So it's really a heck of a bet on the part of angels in general. So how does a venture capital fund work? So if you notice on the left, it says the general partner. Well, I'm a general partner in Lavrock. We have 3 general partners. I'm the managing partner, but I have 2 other partners that we're collaborating all the time. And then you'll see the 4 little dots over to the right that are called LPs. Those are limited partners. So I go see family offices, I go see wealthy individuals and say, would you like to give us money that we'll invest on your behalf into a family of companies? So our fund is 25 million. That's not a big fund at all. And we've done 11 deals. So, we're in the $1 million range per deal. But we also reserve money for follow-on investments in those deals. So hence, that's really a smart way to do it, because you look at the ones that are going extraordinarily well and you reserve some funds for follow-on rounds. Most of the companies, all the companies we invest in are tech. In all but 3, I think 3 of the investments, we are the lead investor, and we've done that with roughly $1 million investment. In the year we invest, those companies are typically in the $1 million to $2 million of revenue. So they've already found customers, they've already gotten that far along. So that's kind of our profile of where we invest. We as general partners are paid, the fund, our management fee is 2.5% on per year of assets invested. So if I have $1 million from you, our fund, including the 2 other partners, me, our travel costs, our legal costs, everything else, amount to 25,000 of that. And then if I take $1 million and put it into a company, and I sell it 5 years later for $2 million, we obviously made $1 million on that investment And we as fund managers get 20% of that. And then we return 80% of that to our LPs, our limited partners. So in a very high level, that's kind of how venture capital works. So what do? We've got to go out and raise funds. I think in some ways that's harder than when I raised money for my first company. It's particularly hard if you're what's called a first-time fund. So we don't have any track record. So they have to believe in our thesis and the fact that we can make money, a little bit like perhaps you as entrepreneurs trying to raise money from folks to invest in your company. So we fundraise, we do the investment, we help the companies grow, we exit, we sell that company, we return it to the LPs, the limited partners, and then we create that cycle again for a follow-on fund. So Sequoia, monstrous fund on the West Coast, this is I think they're the 15th or 16th fund. In our case, we'll go out for our second fund in perhaps another few months. I'm not going to go over this, but I'll give you the deck. In fact, I've already sent it to Tiffany. But basically, this talks about how many funds there are in the country. Of course, it's a little dated, but it gives you an example of the ramp, how much they invest, et cetera. But perhaps a better discussion is here. This is not something I'm excited about. It's sad in a lot of ways. But what you've seen is these venture funds get bigger and bigger and bigger. And the net is then they don't want to invest in real early startups. And it's all a function of economics. So if you have $1 billion fund and you've got, let's say, 10 partners in the fund, they cannot manage the real heavy lifting it takes at the really early stage. So for them to make money themselves, they'd much rather put $100 million into a company that's very, very far along, even though the valuation is going to be much higher, than they would put $1 million into a startup. Because, if each partner's got to handle the deal and be a director in your company, and he's got $100 million, he's got to do 100 deals at that very early stage. And so they do early stage deals, but they do far less. That is not true with us. We're a tiny fund compared to, the really big funds. So we are in that strata of looking at what we call seed stage investing or Series A, which is another word for kind of the investment right above seed stage when you've got proven traction in the market. This gives you another view of the size of deals that the venture capitalists are doing, and is not a bad depiction of where each of these funds is investing and how big they are. Now, this I always apologize for this next slide, but it's an important slide, and I expect we'll have a quiz on this, so I expect you to memorize it. But what's important to see here, this is a reasonable view of the venture capital industry in the U.S. But what's important is you look at these different boxes. Each of these different funds have different thesis, right? So growth equity, if you look at the right box on the top, those guys are only putting out monstrous checks in a company that's already radically proven they can grow fast. If you go below that, you'll see in the larger block, there's East Coast and West Coast. And so you have obviously regional firms that are more active in their region. And then if you look at the little top box there, they say stage agnostic. And what those are firms, big firms, all of them, that will invest not only in startups, but they'll also do, monstrous investments in companies that progressed along the line. So, you can get an idea of the landscape for venture capital in the U.S. At the very bottom, you'll see strategic, and this is a booming area of the market. And these are Disney, SAP, Intel, Cisco, Google. They're actually companies that have created their own venture capital funds. And they do that primarily to drive innovation into their companies. So they find a small tech company that's doing something really interesting, and Lockheed or Boeing, both who have these, will say, well, let's invest in that company, not buy it yet, but invest in it, because we think that product can help us with our mission. Disney does a lot of this. UPS does a bunch of it. And it's, in some ways, if you have a product that relates to these bigger companies, it's an easier way to raise money than from the VC folks, because they'll invest when they see a strategic partnering opportunity that many of the VCs like me, it's generally only financial issues or financial and economics that drive me to invest. This is and by local, this is the Washington, DC landscape. And it gives you a couple of very interesting ideas. Venture capital firms sometimes die, right? So Novak Biddle is maybe nominally there, but they aren't doing any new investing. Valhalla is gone. It was run by a very famous venture capitalist, and he's passed away, and that killed the fund, right? But it also gives you an idea of kind of where they invest, right? Where are their sweet spots? So you can see, Growtech the green dot there is a little bigger. They do reasonably sized deals. Edison, others where you see the arrows I'm trying to depict, where they tend to invest and if they're moving up or down in the market. If they're moving down in the market, it usually means because they couldn't raise as much money in their next fund. You'll see a pink one there, IQT. That's InQtel, which is the National Security Agency's venture capital fund. Very aggressive fund. Biggest, they make the most investments in any given year in the country. They're not big investments, they're typically around $1 million, but they make a ton of investments. And they're, very active on the West Coast, but very active in the Washington area as well. It has to be a product that is believed to be complementary to the national security mission. You'll see all the really big dots over on the right. Those are big funds. Revolution, which is Steve Case's fund, the founder of AOL, probably $1 billion fund. Kleiner Perkins is a monstrous fund on the West Coast, but they come to the East and they've made 4 substantial investments in Washington or area companies. Paladin strictly invests in military related or national security related. Swan and Legend only, as far as I know, invest in hospitality. So restaurants, Sweet Green is theirs, other restaurants like that. And Sands Capital is an intriguing one. That's actually my neighbor and Glenn's old neighbor. And he runs a monstrous long, short, actually mostly long public equity fund. But he also has a very, very solid interest in his own investments in small startups, et cetera. The reason I got him placed both, he'll do a $500,000 deal if he likes it, or he'll do a $30 million deal. So he's quite unusual, but very active here as well. So this gives you an idea of the geographic focus of the angel groups. And as you can see, the whole Eastern corridor is rich with a lot of angels. And then the West Coast has always been very rich. There's what they call the flyover states, which are where I'm from, which is the middle of South Dakota. It doesn't have very many angel groups, but as you can see, wherever you have innovation and you have a fair amount of college grads that are trying to do innovative things. A good example is Boulder. Another good example is Ann Arbor or Austin. A lot of serious angel activity. So, what's the difference between the angel guys and the venture guys? So the average angel investment is $600,000. whereas the average venture capital investment is 2 to 3 million. The number of investors is, 320,000 individuals thought to be in the angel groups, and there's only about 525 angel active venture funds. The horizon, the angels would like to get their money back in 3 to 5 or 5 to 7 years. The VCs are a little bit further along. And to kind of give you the profile they're looking for, the angels want to see 5 to 10 times return on their cash in that 5 to 7 years. The VCs want a lot more if they can get it, obviously. And it just gives you an idea of how they break down. You can see that the average capital deployed is close to the same, a little bit more for the VCs, but does give you an idea of kind of distribution of how that's going to be deployed. The big thing for you in many cases is what is the pre-money valuations they look for, right? So if you look at the left chart, and by the way, they identify different rounds of funding by series A, B, C, D, et cetera. A series D funding will generally be a really big funding. As you can see, it in many cases is 100 million or more of funding. So obviously that's a very healthy, that's Lyft, it's Palantir, it's it used to be WeWork or groups like that command huge amounts of money in valuation. Whereas if you look at the seed series on the left in that chart, you can see that the average funding and the pre-money values of that funding are low. They're 3.2 million to 5.1. So it just gives you an idea of how the valuations are expected to grow as you would grow your company, bringing in VC money. This gives you just another view of how the VCs work. And by the way, don't underestimate the value of some of the crowdfunding things. If you have a product, a widget, many cases you can go to some of the funding groups that are out there, and you can actually pre-sell your product before you build it. If you have the right kind of product that consumers might like, it's a great way to consider bringing in capital. The other thing that's intriguing is the internet has changed everything. On one hand, it's made it more difficult for founders because it's produced so damn many founders that have got their own little app that they're running on the internet. When I started my company in 1982, my first one, there was no real internet. There wasn't an internet. So I had to buy servers. I had to buy lots of technology so that I could try to build my product in-house. Today, you can spin up a product really cheap. I talked to a company yesterday, trying to raise money. They have 3 developers. This is amazing. I think all 3 in Asia. I'm not sure what country, perhaps Vietnam. They're paying them $2.60 an hour to build the software prototype. So, it's what, $8 an hour total? And these folks over there are actually building in the prototype of the app. Will it be perfect? No. Will it be a good enough for kind of alpha and to show people and to try to convince people to buy it? Yes, could be. So there's a lot of cheap ways now to try to build particularly a software product out there. So, I always say, what's the best due diligence indicator of a company's success? It's, does anybody really want to buy your product? Very hard, to find that out. But I can't tell you how many entrepreneurs think they've got the world's greatest product in the world, and when they really meet the market, it's very hard to get people to buy it. It's I think the hardest thing of all with the company. So I'm a little tiny investor in the scheme of little tiny investors. And, I can't play in huge markets. I just can't do it. I can't fund WeWork or Uber or whatever. So what I'm trying to find is companies that I can jump ahead through my intuition and experience to say, I think these guys have pilots, and those pilots give me confidence they'll move up to that green line, which is first real revenue. Obviously, if I invest at the pilot stage, I expect the valuation of the company to be lower because they haven't proven themselves. If I invest at the green dot, then it's going to cost me more money for investing in the company. This is just a rough cut. I've been doing this so long that I have many companies that are in all three of these buckets, where I put a little bit of money in to try to get them going. Some of them grown up to be bigger, and then I move up to bigger companies that I hope obviously have gotten real revenue traction and proven they can do well. So, how do I make my money? Well, there's two metrics that I'm measuring, and what they really are is revenue and revenue growth. So revenue growth is the real driver to tell me if the company's going to be successful. And I can tell you, I have two companies that I'm an investor through our angel group that have been around, 7, 8 years, have absolutely hit tremendous inflections on their revenue growth and their valuation. Both companies are approaching $1 billion because they've just proven they can sell their product. So the other thing to think about is, how do I make the most money? And I make the most money in what's called an initial public offering. I don't think anybody should aspire to do this. I did it with my company out of luck. And I have one more company in my entire portfolio of 170 that has actually filed to go public and probably will in the next few months. But as you can see, very few make it to that hurdle. And in order to make it, you just have to have astonishing growth in the market. So I don't, every one of my other exits, of which I have about 35 out of my 170 investments, have been the sale to a bigger company. Or in some cases, and this is relevant to you, I've made the money through just cash flow of the company. Company's never sold, but every year they distribute out profits to shareholders. And that can be very lucrative and very satisfying for you as investors, you as founders. So in my case, I've done this over 30 years. I've actually now had more like 35 exits since when I put this together. I had 27, and my returns have been almost 30 times my cash. So that's wonderful. And what's called IRR, which is that return measured over time. So every year it's a ticking clock. I've got to, I have to take into account how long I've been in an investment, but my IRR is 55% on those 27. And I've had 2 IPOs. So I'm not obviously getting a lot of, as they say, wood on the ball on the really profitable IPOs. So what do I look for when I'm looking at a company? I overlay everything with instinct. So I've been doing this long enough that I frequently can look at a company or a team and get comfortable quickly or not with it. But then the most important thing to me is the team. And you might be a founder of one person. So then to me, that means how effectively can you be at recruiting a team? And I always say it's designed to be 32% of my thinking or binary. Why is it binary? Because if you come in too arrogant and you think you know everything and you're trying to explain to me that, I'm usually done with that discussion in a few minutes because you'll die. If you're too arrogant, you won't be able to recruit a team. You'll struggle with customers. You'll certainly struggle with investors, and it'll cause the demise of the company. And you have to be confident, but if you're arrogant, I don't really want to invest. So I usually stop the discussion there. Then you'll notice that I think the path to market is actually more important than the concept itself. Part of that is because my best teams have frequently pivoted. They've come up with one idea, and after a period of time of finding little market acceptance, they've pivoted, they've been very smart, and they've done extraordinarily well. But you're going to spend a lot of your time trying to figure out how to get customers to buy that product. And to me, if you've got shortcuts or other really interesting ways of doing that, I get really excited. And then the concept, I consider 20% of my thinking. It is fair to say if you have a bad concept, your path to market is probably going to be a struggle. So they go hand in glove. Then there's the market itself. And I don't place as much merit on that. And the reason is all you entrepreneurs try to show me a deck, a slide in your deck that says our market is, 10 billion. The fact is, to get to a market like that is extraordinarily expensive. And that's going to be much more money than I have. So I'm not super interested. What I'm interested in is, do you have really a solid niche that's defensible in a market that typically is a lot smaller than Uber or, or Google or the really big tech companies. And then the last is valuation. And if your valuation is 10 times what I think mine is in my head, we won't ever get there. And I usually say, you need to go talk to other investors that might, I guess, have an appreciation for what you think the value is. But if you're 20% off me, we'll get there. So it is binary, because if you have real expectations I can't rationalize, then I won't do that. So, that's why we little investors like relatively small markets. We can fund a small market. And the way I best define this is, what's the fourth most popular search engine? And there's a lot of discussion. It could be DuckDuckGo, it could be other things. But when I built this chart, the fourth most popular search engine was Ask, which used to be Ask Jeeves. Well, they put $100 million into that, trying to compete with Google and Bing. And they finally sold the company for $75 million. So they lost $25 million. In other words, I can't fund the next Google. So if your idea is frankly too broad, it's not good for us little investors. I can't command enough money to make you successful. So when companies fail, what you see is three things that can happen. One is they cut costs. The second is they go ask me for more money, happens all the time. Or third, they go out of business. Because usually if you're not doing well after your first round with someone like me, you're not going to find another investor, because they'll look back and say, well, this guy Hunt lost his money in the last round. Why do we want to fund this? And in many cases, I have to decide either abandon the company or put more money in. And it cuts both ways. I've done it both ways. So I am good for more money sometimes, but I can never keep up with the giant VCs of the world. So that's all I have. I hit it, I guess, pretty much right on the money in terms of time, but I'd love to take any of your questions on any aspect of this that I can help with.
Koshi, I know you have a list you've been keeping.
Yes, we have a list. Tiffany's gonna go ahead and start with the list. So Tiffany, go ahead and ask the questions. So
All
everyone,
right.
just feel free to put your questions in the chat, and we'll make sure it gets answered.
All right. So I think the first question he answered, which was, what is he looking for when he invests in his money into a business? Let's see. Number two would be avenues and methods to pursue capital for a small business outside of loans. Is it realistic to pursue venture capital for a small business?
Well, that's a great question. It's a little open-ended, but let me give it a try. So I always, when I started my first company, I thought banks were there to loan me money. But to be honest with you, they're so conservative that in almost every case, and there's some exceptions, I'll talk about them, but if it's a traditional commercial bank in downtown Norfolk, as an example, they typically only invest on positive cash flow companies. So there are exceptions, but that means that you've already got to be making money. And it, to me, was incredibly disheartening, because I thought banks would give me money. And I figured out very quickly that they just don't do that. Unless you're up and you're solvent, then they're trying to fund your cash flow. They are funding your receivables, but they usually want to see a strong balance sheet that perhaps you've been building over 2 or 3 years that shows that you're growing the company and growing it profitably. So banks, by and large, are not very good at this. There are some specialized banks. The best known one is a bank called Silicon Valley Bank, and they do take a lot more risk. So what they do is they will give you a loan. They're still very stringent and it's hard to get, but they'll give you a loan. But the loan, in addition to taking interest on the loan, they take some equity in your company. So they might say, we'll give you $100,000 to get the company started. But in addition to, let's make a number up, 5 to 8% interest, it'll be high interest rate because you're risky. And B, they'll say, we also want the ability to buy 2% of your company thrown in. But they are way more liberal than the average bank down the street. I think the best and easiest money to find for a startup the best money are going to be the people you know, to go to people you know. Hopefully you can capitalize your company at the early stages with not very much money. And then the second best are grants. And most people don't understand how to really look for the grants and how to best position for the grants. But I'll give you an example. I didn't fund this, but a couple of really smart grad students that I know came up with it's really, they're both athletes. One was a basketball player at North Carolina and the other guy was a football player at Stanford. And they concluded that learning the playbooks now are impossible. There's just too much to learn, too many permutations. So they created a package that teaches, in their case, athletes, shortcuts to learning the playbook. Well, they thought that was their market, and indeed they've gotten some traction there. But the Air Force looked at it and said, this is a package we absolutely need to teach our pilots, because evidently the alternatives as a fighter pilot are sort of like an athlete. You better be able to figure out stuff really fast, and it's just way too many inputs to try to learn in a textbooks. So the Air Force gave them a 7-figure contract to adapt their product to pilot training. Now, who would have thought, right? So there's all sorts of things you might think about that could apply to different markets that get very interesting. And there, in particular, federal grant money, but there's also state grants, there's foundation grants, et cetera. And I really encourage you to exercise and look at that, right? I looked at a company that Jim and others helped me with that's doing sort of elder transportation. Well, I would absolutely exercise grants potentially in the region, because it's quite regional, that might piggyback. The other thing you'll find with grants is many times when you get the grant, then the VC or the angels get really interested because they realize you've gotten money to propel your business that doesn't eat into their equity. So that to me is a really big deal. The biggest program in the government is called SBIR, Small Business Innovation Research, I think it is. And it's run by the Small Business Administration. And every one of the departments have them. DHS, HHS, social, they all are parties to these grants. NIH is really big at it and DOD is really big at it. But I really think you should study that because you may find fits you never thought of before.
All right, so our next question is, what is the likelihood of investments in this uncertain pandemic time?
Well, that's a good question too. So the minute the pandemic hit, a lot of the VCs, or frankly the angels, timed out. But they only timed out because nobody has an idea of exactly what's going to happen, right? Will we really open up in July? Will we open up in October? Is it going to be next February? So they all sat on their hands for a bit. But a lot of them absolutely believe that the valuations are going to go down. And the valuations have hit a historic high because there are a lot of VCs investing, and they've, valuations have gone up. Well, if the valuations go down, it's a more attractive investment for the venture capitalists and angels. So now you're starting to see them open up again. They're beginning to get a better view of what does this pandemic mean. Let me give you 2 examples. I have a company that did nothing but service the hospitality industry. They had 2 or 3 very large contracts with the Hiltons, the Marriotts, the others, Sheratons of the world. When the pandemic hit, their business totally stopped. Marriott doesn't have anybody in the hotels, so they're not going to pay this group to do this technical innovation for their hotels that they'd lined up. It's still there, but it may be a year or 2 years before they see that market come back. On the other hand, I'm an investor in a company called Avizia that builds telemedicine solutions. And they've now merged with a company called Amwell. Well, Amwell just filed to go public. And telemedicine's going absolutely nuts, right? Because docs can't see patients in some cases, or it's more efficient to do it via telemedicine. So that company's killing it. They're doing extraordinarily well. You could say the same thing for Zoom, right? Which we're of course using. You could say it for other collaboration packages that use the internet to bring people together. So it all depends on the industry, but I think you'll see the venture guys really swing more into active investing at a bigger scale, maybe August, and they're already starting to look at deals, with serious activity.
The next question is, does venture capital make sense for a company focused on long-term value creation, for example, over a 5 to 10 year horizon?
Well, yeah, 5 to 10. First of all, every entrepreneur is way too optimistic on their timelines. I always say, of literally thousands of business plans I've reviewed, I think only 3 have made their first and second year projections. Now, I'm used to that, so I kind of factor it into my thinking. But I want you to be optimistic. I want you to think you can do well. But the fact is, it takes you a lot longer than you think. One of my board members in my last company is a kind of world-renowned venture capital and angel by the name of Brad Feld. He's a very prolific blogger and very, very bright in this space. And Brad's always says to me, Jim, when I get a deck or an investment possibility, I double the amount of cash the entrepreneur thinks he or she needs, and I double the amount of timeline it's going to take them to get cash flow break even. And he goes, I'm wrong a lot, but I'm right more often than they are. So I think if you think you can get your company to a position to sell, because you're going to have to sell if it's a venture investment, not necessarily true with angels, because we'll take our money out as you go. But if you're going to have to be in a position to plausibly explain to the investor you can sell in probably 7 years. And by the way, this is another important thing to think about.
Anything else I can help with?
Which is what is the life of the fund, right? So if you raise money really early in a fund's life, it gives that fund more timeline to return money to their limited partners. Whereas in our case right now, if you raise from us, it's the very end of our fund, our first fund, and we've got to return the money faster. So it's actually a good question to try to ask the VC is, tell me about the life of your fund, and you need to understand the profile of where they are, because I've got to return cash to my LPs in 7 years. I can get a couple extensions on that, but that's the general rule. So hopefully that may answer that question.
The next question is, do you have any tips for one to enter venture capital as a career, especially for someone coming from an HBCU and not an Ivy League or an Ivy League school or Stanford?
So I'll give you a kind of a interesting analogy that I heard. on that subject. Glenn can relate because this is also a neighbor of ours. And he's allegedly the highest paid attorney in Washington. And he's a wonderful guy. He came over and had a beer with me the other night. In his area of laws is SEC securities law. So guys that do bad things with trading stock generally. And he said, he was in a meeting. He's in a real highbrow firm here with Yale and Harvard and Georgetown law grads. And this Harvard grad, who's one of the senior partners in the firm, said, it's kind of beneath our Harvard grads, law grads as associates to go out and research papers for a case we're working on. We need to leave that for the, grads from other, lesser known universities. Well, it happens, our friend Bill is a graduate of Temple Law School,
Right.
Not a prestigious law school or well thought of at all necessarily. And so, of course, he took serious issue and he said, yeah, the difference between we Temple grads when we started out as associates is we didn't care what the work was. We just wanted to learn. And we're the guys that did all the damn work while your Harvard grads didn't do the work, right? Or didn't want to do the work. So I think there's a couple things, and this really relates to minorities as well. There's no doubt that the venture capital industry should be very disappointed in their homogenous white profile. It's absolutely the case. And it was true some years ago with women, and the women, I think, have done a remarkable job of increasing the population of women VCs. Still not where it has to be, but they've done a pretty good job. And they're proving themselves to be very, very good. There's tons of great examples of that. There are groups that only invest in women. One that's well known is called Golden Seeds in New York. It's all women, cashed out, wealthy women. They only invest in women that are in the executive team. And there's now becoming, I think, far more understanding of bringing on people from perhaps backgrounds that weren't considered in the past. That include, folks of color, but also just generally probably not the Ivy League or whatever. So it is very hard to get into the VC ranks. I did it, as I said, by slipping in first as an entrepreneur, having success investing my own money, which gave me a chance to move into the VC ranks. But I've been teaching at Georgetown for 25 years and Notre Dame half of that. And I've had a whole lot of my students who've gotten into a VC. By a whole lot, maybe 24. And they did it in a variety of ways. If I were doing it, because the VC population is so small, imagine our firm's 25 million, that's considered a little tiny firm. But we have 3 general partners, and then we'll bring in an intern in the summer, and that's it. We don't have any associates. But what I think is probably more practical is really learning about how a startup works. So go into a startup, really getting an understanding of that, because the VCs are beginning to take founders that have been successful or even ones that have failed but have learned a lot, and they're bringing them in because they give them a perspective that you just don't get by rising up from, I don't want to pick on Harvard, but a Harvard MBA who's made the ranks. I think Dean Carrington can talk about how, for example, in the accounting profession, it's now totally incumbent on the big and small accounting firms to recruit minorities and others, because your big customers want to see that profile in your audit teams and in your folks presenting. So it's going to take a long time for the VCs to catch up, but I think the decided approach is that they're very, very genuinely trying to do that.
All right, the next question is, the VC fund structures that you presented are helpful to understand how VCs are organized. However, is there a general way the companies being backed are organized, such as LLC, C Corp, S Corp, et cetera?
Really good question. So, the simplest way to to form for company formation today is an LLC. And you can do it really fast and it's pretty cheap, and it's getting to be way more understood in the market. VCs, many cases, probably most cases, will, if you are an LLC, will try to get you to convert to a C Corp. My daughter, one of my daughters, I've got a whole bunch of them, but one of them just started a company, and she was going to be an LLC. And while the paperwork's a little trickier and some of the governance docs are, I encouraged her to incorporate as a C Corp. You can get the same tax benefits as an LLC, which can be substantial, by doing what's called a subchapter S election. A VC will make you move out of that election. They'll make you move back to a C Corp if you do that. But by and large, C Corp is better. When is it not better? If you don't expect to grow big, an LLC can be good. The LLC also has advantages in things like if you want to be a sub S corporation and take advantage of what they call pass-through taxation laws, an LLC, an S Corp has to be U.S. citizens as investors, and it can't be another LLC. So, for example, I have an LLC I invest through. I can't be a nested LLC on another LLC's cap table. So there's real advantages. I can't be investing in an S Corp. So there's real advantages for quickness and speed with an LLC. They structure them differently, but I think as you're starting, you're okay. Then if you ever got to the point of trying to bring in outside capital, you might actually have to convert. And that's painful because it's just a lot of paperwork. But I don't care either way. The other thing, and this is really esoteric, is we investors pay very close attention to the tax implications of a small qualified business. And if they won't consider an LLC in this yet, I think they may at some point. But basically, if I've held a stock in a small company for 10 years or more, and then there's other gradients that work as well, when I sell that stock for a profit, I actually can avoid the capital gains tax. But I can't do it with a convertible note or an investment in an LLC today. So that drives my behavior as an investor to say, in many ways, I'd much rather have you be a C Corp. So there are some weird nuances in the tax code that are worth studying, but they're from you starting out, they're probably too esoteric to worry about.
All right, next question is, what are your conditions for repayment on pilot programs, or do you wait for them to gain traction first and convert the terms?
Well, that's a great question too. So if I had my way, I would tell all companies to charge for their pilot programs. It's sort of easy for me to say, right? Because the advantage is, particularly with enterprise software, or an enterprise product, hardware as well, is you are so much better off when you go see an investor by saying, XYZ Corporation is testing my product now. Now you can bet they're going to call them. So you want to make sure that it's referenceable. But the reason I always worry about free pilots is I worry that the company is being very gracious to you and saying, I want to try your product, but then they don't spend any time or energy in really exercising the product. So if you get them to pay a little bit, it can be obviously very de minimis, then they don't want to just neglect it. Because I can't tell you how many references I've called, said General Motors is testing my product in a pilot, and I get a hold of General Motors. And yes, the company sent the product there, but nobody can even find who's really sponsoring the pilot. So trying to drive behavior of those pilots is important. And one way is to say, my product's going to cost you $100,000 if you buy it someday. I'll put a pilot in for $10,000, right? And I can tell you Notre Dame has a great program in this where they've raised some donor money to match a first customer's payment. So imagine you have a pilot, you're going to get it into a company that could be a very good reference for you in whatever field you're in. And they say to the company, this pilot's going to cost you $20,000, but we at Notre Dame will pay half of it just to try to get traction for a company we're trying to promote with alumni or students. So I think there are interesting ways there. But obviously the best pilot is the one that when they get to the end of the pilot, they have to have the product and they buy it from you. But whatever you can get that shows customer traction is important. So if you have to give it away, I guess you do. But again, I worry about them really using it if you do that.
All right, real quick before I ask the next question, I just wanted everyone to know that the session will end at 11:30, and any questions that don't get answered will be sent to Mr. Hunt by email. And if your question doesn't get answered during this session, just leave me your email address so I can send you the answers.
And I try to get to those. So I'm very hopeful I can help you if we don't get it covered.
All right, so the next question is, are you funding any multi-use developments in the area? And if you are open to them, if given documentation?
I guess I need better definition on what a multi-use would be. So I'm not sure that maybe they can chat you that. But if you're talking about a company that maybe has a product that fits into a whole bunch of niches, I will tell you, conquer the first niche. Make sure you focus in on. Don't be too broad, because if you're too broad, I can't fund you. You're going to be trying to do too much. So if that's what that question's about, that'd be my answer to that.
All right, next question is, among small businesses you've invested in, do you find gender differences? Are females more likely to invest in some fields and males more likely to invest in other fields? And if possible, can you share some examples?
Well, absolutely. So I was an investor in a company with a woman CEO in Pittsburgh, and Golden Seeds was my co-investor, because again, they only invest in women. You don't have to be the CEO, but you've got to be a woman executive on the team. There's also a fund here in DC that's focused on women. I forget the name of it, but they pretty much only will invest in a woman executive. One of the things that disturbs me when I look at the management teams of companies is, and I hate to say this, but many of the women get typecast as head of HR, maybe head of admin, or some other function in the G&A area. And I always worry that maybe the company just hired that woman because they need a woman on the team, and that's a logical place. But what gets really interesting is where you see a woman in a chief revenue capacity, chief engineering capacity, chief technical officer, CIO. A very good friend of mine, incredibly accomplished woman, was just made the CIO at CIA. And she's going to do great. I have 4 daughters, so I'm particularly inclined to try to help women if I can. But I think the same is also true with minorities. That it's really good if you can see them in the executive teams in position of influence. And it may be too early to say that, minority venture capitalists invest in minorities, but they're certainly more sensitive to it, for sure. And true with women as well. The bad news, and I say this with 4 daughters, no sons, is the women are in general better organized, and in certain things do a heck of a lot better job. Don't quote me on that. I'll be run out of town, but it's the truth.
All right, next question is, what's your opinion on the next generation of funding alternatives like STOs?
Well, there's a lot of great stuff spinning up. The crowdfunding initiative has gotten, tacit approval from the SEC with certain bounds. They don't want a grandmother losing her last $10,000. So there's protection in there, which should be. but the crowdfunding swinging up is getting a lot more prevalent. The things like Indiegogo and other funding apparatus where they don't take equity, but they help sell your product in a kind of pre-release format is very, very interesting. And I think you're going to see a lot more of that. You're seeing, in a way, it's sort of crowdfunding, but you're seeing giant syndicates of angels pop up who do it all by, they get presented a deal and they will meet the company and they feel comfortable somebody will watch their investment. It's like the old angel groups, except with a far wider wingspan. So I think you're seeing a lot of that. I think you'll also start to see derivatives of, not necessarily venture funds, but derivatives of banks get more risky and consider riskier profiles with their money. And they probably can't do it under the banking laws, so they'll set up other entities to do that. And then last, not to mention the grants, which I really think is a big area. A lot of the strategic funds, strategic companies now have good-sized venture funds, and they have incubators. So you can get into a company's, if you had a product that made sense for a Disney, they'll help incubate your company, and those can be very, very gratifying. Some aren't any good, but a lot of them are really good. And going to an incubator will teach you a lot.
Next question, how would you feel about a company that has an SaaS built on another white labeled software platform? And does that make the company more of a marketing company versus a true software company?
So if I understand it, there's a ton of people like that, right? So I just talked to a company in San Diego that has a cyber product that sits on top of Salesforce. Salesforce has their own cyber products, but there's evidently a gap in their offering, and these guys are doing $1 million a year selling their cyber product on top of the SaaS product. So I think that's a really interesting area and one that's worth pursuing. Part of the thing the venture guys will think when you do that is that the logical exit for the company, right? Is that underlying SaaS company likely to be who you could sell your company to as you gain more momentum and, you know, the underlying SaaS company decides they're interested. All the big SaaS companies out there are very acquisitive. They're buying companies right and left that are tuck-ins to their core product, you know, Oracle, Salesforce, SAP. SAP has their own venture fund here in Washington and elsewhere called NSU, mostly national security related. But again, lots of activity in that space right now. Now with the coronavirus, some of the balance sheets will get hurt and they may tone that down, but that's a really good market for you.
All right, last question is, how likely are you to invest in a pre-revenue generating company?
Well, I do probably more than I should. So I do that. As I've mentioned though, where I see a lot of companies coming out of schools, you guys included, they're to me companies that you should consider for cash flow. So I'll look at those because they may never exit and you as a founder may never want them to exit. So if you're building a great little consulting company, a great little services company, and it's quite regionalized, a venture guy may never want to look at that, but an angel might, because some of my best companies cash flow. That means every year they're an LLC or a sub S, and they pass me down dividends and distributions. And some of those are very gratifying. So if you aren't really well postured for an exit, it's probably not something a VC will consider. By the way, some of them that distribute really well eventually get bought. So they're not mutually exclusive, but they're designed when you as a founder are making $1 million a year and you're not so sure you want to sell because you have a great lifestyle. All I want to know is that I get part of your money every year for my investment. So you know, angels will look at that either way.
All right, those are all the questions. Any additional questions, I'll email them to you.
No problem at all. I'm happy to help.
Well, Jim, thank you. Thank you. This has been really good, really good. We appreciate your effort and your patience. Ooh, been sitting there for a while there. So, so any last question of us, Jim?
No, you guys are, you know, you're doing the right thing. I mean, I think you're really aggressively getting out there with your programs, and that's what you have to do. It is still statistically hard to, you know, always make this work, but you know, it's like everything. You've got to be perseverant. You've got to really work at it. And if you do, certainly you'll have certain successes. And as I say to entrepreneurs, even if you fail, the entrepreneurs that are a problem are the ones that don't learn anything from the failure. If you learn, we venture guys frequently are listening to an entrepreneur who was not successful in their first endeavor, and we're, you know, we can get comfortable with that as long as we think you've gained a lot of experience from it. So it's like, I guess, skiing, as they always say, if you never fall down, you probably never learn to ski very well. So you got to be unabashed at trying to get out there.
Okay. And Jim, if there were one thing that we would do, you say we're getting out there, we're putting our effort forward, we'll fail and get back up, you know. But is there anything we need to do kind of educationally or strategically other than that effort?
Yeah, that's a great question, Glenn. The thing that I think has been failing, so imagine you have a company that produces a widget, a product or a service, and where they'll really find it difficult is trying to get somebody to use it, whether in a pilot format or buy it. It's obviously better if they buy it.
Right.
And so trying to, you know, use contacts that the university has, contacts in the community, but being able to reach out and say, not only does my student want to intern with you, but we want to test a product that we think can be impactful in helping your business as well. And to kind of get that, you know, nudge over the transom, over the hurdle of getting the product into a real user's hands, I think is where a lot of organizations fail, not just universities, but venture funds, et cetera. So anything you can do, you know, you go to my friend in the, you know, yours, Jeff, right, at Embody, and say, is there anybody, any of our processes, our service, our talent that can help you with your mission? Because, you know, your students need mentorship, not just in the classroom, but in the environment. So that'd be one thing I'd focus on.
Okay, good. Fantastic.
All right.
Coach,
Thank
you
you.
want to say anything?
Yeah, thank you so much, Jim. This will be the end of it. We have some links in the chat. Tiffany has done a nice job. So we have some links in the chat for you guys. We need you guys to follow us on our social media pages, especially our Facebook page. We have a LinkedIn page, Instagram page, and a Twitter page. And we're working on also building a YouTube page. So all these content can be available to you. If you haven't subscribed to our newsletter and you want to get this recording and our follow-up message for this particular event, we need you to subscribe, and it's the very last link that for you to subscribe. So make sure you click on that link and subscribe to our email list so you can get the recording and our follow-up message for this event. If you have any questions, please make sure you just reach out to us and we will be willing and ready to answer. And I see all the thank yous. You guys are so welcome. We love doing this. And we appreciate Jim for recognizing that we're really pushing forward into solving some of these problems and creating opportunities for our audience. So welcome, thank you, not welcome. Thank you, everyone. We'll see you next time on our next workshop. Have a good one.
Great, thank you. Thank you, everybody.
Thank you.
Yeah.
Fantastic.